This will be a little bit basic, and then we'll get into a little bit of fun stuff as well. As we know, the market is doing one of two things at all times, sometimes simultaneously. It's either trending or it's ranging. So if we're determining how the market's going to move, essentially in this movement, you've got multiple different time frames that are doing specific things. For example, you have your intermediate time frame doing something like this. This could chop around in range in a higher time frame for a long period of time, and it's got what we call internal structure, right? So the higher time frame might be doing, let's just paraphrase for right now and do this, right? So there's your higher time frame movements. I don't mark this out because it's not relevant in terms of the higher time frame, right? We're looking at the higher time frame highs and lows. This wick, we can sweep these protected lows, and we'll get into that in a second. But this is higher time frame structure. Within this, you have lower time frame structure, which is facilitating pullbacks and retracements, right? So for example, this is a higher time frame retracement, which has very little to no structure on your lower time frame as we trade back down to either take liquidity or trade into areas of interest, right? Now, once we've achieved this objective of mitigating here, you'll notice that you have internal structure that forms. And this is where we start getting really excited, because quite often you have something exactly like that formed. You've got this internal movement facilitating your higher time frame bullish trend, and then you have this lethargic movement that leads to a movement back into your prior zone, right? And this is where we start getting excited, because this usually is of a retracement nature, especially after we've changed order flow on our lower time frame, and then we leave. And then this movement here, from that high to that low, it's one of the main things that we look for. And the reason is because after price has tipped its hand, which is essentially what we're watching for price to tip its hand, right? For example, this move, if we're expecting bearish structure to continue on, you either want internal failure or you want a break of structure, right? So what ends up happening here is we break, right? Price tipping its hand that this movement down is done, and then we get a lethargic retracement. Lethargic retracement back down to where? This area of interest, right? Where this bearish movement was done. That leads to a higher time frame. Ideally, that breaks. Usually you will see that break. And if it can't, then you're looking again for internal failure, which then leads lower. And we consider this to be a weak low, right? There are no such thing as protected lows in a bearish trend. There's no such thing as protected highs in a bullish trend. By definition, if you're trading inside of a bullish trend, you will have a valid high that puts in a low, and our expectation of this low is to become protected and break that high, as we know, right? Where it gets fun and confusing is when you get the multi-time frame analysis perspective in this, right? Now, to go into these movements here, we consider them to be swings. And there's two kinds of swings. We haven't really gone into non-structural swings, right? So the key difference between a structural swing and a non-structural swing rather is that we typically like to risk off of structural swings. We do not like risking off of non-structural swings, right? As they didn't really achieve anything. The obvious difference being SNDRs, right? Quite often you'll see SNDR that are not structural swing-wise, right? They don't make a valid high or a valid low. However, we want to be risking off of those as we essentially determine swings itself as areas of interest in the market that were responsible for something, right? And from a basic standpoint, this low has to put in a body closure above this high in order for this movement to be considered a structural swing. And then the reason that we consider it an area that we want to risk into is that this area now produced a new high in the market. So we expect that to continue, right? And SNDRs are key areas as well inside of that we look at the market made a decisions, right? So somewhere in here, the market made a decision to continue higher. Somewhere in here, the market made a lower time frame decision to continue higher, right? So we want to be trading alongside those areas of interest. Now, non-structural swings. What's their purpose then? If they can't make a valid high or a valid low. Sometimes we trade into them when they're SNDRs. We just went over that. However, when the market is attempting to sell off, and even if it can't create an area of interest, the key that we look with swings is that we're essentially trying to determine, using market structure, how strong is this trend? How long in the trend are we? Are we expecting a reversal soon? Now we can use different things, like maybe you can use projections and you're looking at the manipulation leg, and now we're mathematically trying to determine what we expect the high to be. But from using a structural perspective as well, we can determine how many attempts to reverse the trend there are. Whether they're structural or not, we can see, right, in this bearish movement, or bullish movement rather, right? You've got this movement down. This is sideways. You got this movement down. This movement here, you could argue, even though it's not structural, we didn't put in a valid high in this move, but there was a credible attempt to reverse the trend here. This just went sideways, we accumulated. But here, we actually tried putting in a valid low, or valid high rather, sorry. And then we ended up breaking order flow and then continuing higher. So I would consider this an attempt, not an attempt, that's an attempt. So now we're getting a little bit deep inside of our movements, and we're nearing a potential reversal point, at least to a prior zone or area of interest on the intermediate time frame. This could only facilitate something like that, or it could actually drop quite a bit deeper depending on structure. And now we're starting to look at, in terms of velocity and how far we want this to go based off of the structure that forms in here, for the same reason that we talked about the post market today. And then you'll notice very similar stuff in here, right? Attempt to reverse the trend. That actually tried breaking below that. I don't think it did. You're seeing many attempts to reverse the trend. We're nearing at least a little bit of a retracement, right? And then that eventually comes. Usually you'll see that after 5 or 6 attempts of reversing the trend, right? Okay. Now, digressing a little bit, as non-structural swings, it's more of a narrative thing where you should have little warning bells that that we need to be staying out of trouble, right? But we like to look for those when we're in bullish structure, and now you've got this lethargic movement, many attempts to reverse the trend, leading to climactic price action and then a rocket ship, right? Now, these movements, how do we use them? We like to get in here, right? For the same reason that we look at price being fractal, and we've got, say, a bullish move. So this is your higher time frame. You've now got something like this occurring on your lower time frame with structural and non-structural swings. And then eventually you get something like this. Now this first movement is designed to be a scalp, right? It's broken structure. And then we expect a lethargic movement in, and then a violent movement to come off of that, right? Now, sometimes these will occur, and you'll have these movements kind of trade back in. Maybe you get like some sideways accumulation as people realize they're on the wrong side. And the idea with this movement is that we take all of the protected highs on the bearish trend down, and we should take them violently, because this is now of a higher time frame, whereas this was, say, on your 1 minute or 5 minute or something like that, right? So in these movements, ideally we get a trade back down, ideally. And this is sort of where we use the wombo combo, right? So let's do something like this, right? Let's use that. And we've got our clear retracement, and we want this to align with the area of structure, but we're now looking bullish. We're not chasing in here. We're not chasing in here. We're not even chasing here, although you could, right? All three of these trades, if you have fair expectations of price, could make money. But my point is that we're not expecting, or ideally we don't want this to just wreck. It could, depending on the mitigations that happen in here. But we want that change in order flow to then trade back into the manipulation leg. And then ideally this movement will then break structure, right? But my point is that we're looking at these lower time frame movements that then facilitate higher time frame order flow, right? Now, when we start building our narrative, we start to look at when we expect or we get something like this happen, and our expectation is that high. Now we start to build ideas of forecasting on how that should occur, right? For example, you have a violent move, it trades back in, you expect to have a violent move. Why? Because this low on a higher time frame should be putting in a new high on the higher time frame. So ideally this low puts in a new high, right? So if we had a higher time frame movement come out of this, you're looking at this low going, well, that's not what I want to see. It is what I want to see in terms of lethargic movement, right? Does that kind of make sense? And our expectation pretty much until what happened in here was that we had the exact same thing happen both on a higher time frame that our lower time frame is going to do. That's price synchronicity, where we get this movement down, we then do something like this, and then we cook, right? Back into this area of interest, happy days. All this makes sense. So why are we not moving out of here? Why are we not getting that violent price action, right? Why are we not getting something like this where we then capitulate all the shorts? And that's when you start again to have that sort of let's stay out of trouble type mindset, right? And you're looking for the potential, the increasing potential of higher time frame failure or internal movements that fail. So you have something similar here on the lower time frame, which then takes that low. You then accumulate for a while. We then have the intermediate time frame internal failure here. And now, even though we're not really expecting this low to go, even though you would consider it weak because it didn't take that high, structure and order flow isn't really justifying that, right? But that internal failure here, you'll notice that internal failure swept something internally. We didn't get that in this movement here. So we're getting a little bit more advanced from a basic structural overview, but pertaining to the time frame, if we had this high come down and then we swept and failed and then came back in, now you're looking at this low going. That does not make sense to us with that internal failure, right? However, this low is achieved by this internal failure here. So we have to kind of look at what structure is doing internally here on this time frame, but is it still intact on this? And I don't know if that makes sense or not. It's a little bit of an abstract concept, right? So this ends up knifing down, and then what we end up happening, if we're going to go lower, we don't want to see this strong move have internal structure that starts forming here. We want this to be a higher time frame movement, which should be gone, right? Because this move failed to break this low. We've not created any higher time frame movement despite what this looks like. Is this all making sense, or am I kind of going off tangent a little bit? I feel like I'm going off tangent a little bit. Did I lose you guys? Right, so you get this move. So if we're going to fail this leg here, and you've got essentially your intermediate time frames now done something like this, right? Your higher time frame low is still here, and we know that it's higher time frame. Why? Because the amount of time that this has taken, right? That was Sunday open. You've now got all of Monday's price action, majority of Tuesdays. We're now into Wednesday. Nothing's been taken. We're talking multiple days here, right? So we can tell this is a higher time frame movement, whereas these are sort of intraday moves that are facilitating what's going on there, right? So in other words, if we're here and we're looking at this movement up, we don't know if it's going to tap into here and continue lower and then we get failure. We don't know if it's going to do what it did essentially and do this. We don't know if it's going to do this, right? But our expectations are, until proven otherwise, we're seeing a higher time frame move come in. And if this cannot break this, right? That doesn't mean go long here or here expecting this high to go if you're trading options or whatever else. But what it does mean is that we're expecting our diagram, like this is offside for us. We're betting against structure there. Right? The trick is when to determine that this is not a weak low. Right? When is that weak? And in my opinion, if we're going to break this low, this movement has to be of a higher time frame. Right? And I can't look at even one higher time frame shove and determine that that's a higher time frame move that's going to eventually break this low and just trading back in. Right? So it's not the move. Similar to how we look at failure. It's not the move, it's the response. So from a lower time frame perspective, right? Given here, let's say we're here and it's 9:30 on Wednesday the 12th. Okay? We're here. Our expectation from a lower time frame is that we trade back in and we continue lower, right? Or an intermediate time frame, both are valid. But what's our higher time frame structure? And I don't mean being silly, because if we zoom out far enough, we're going to determine that all markets are bullish and there's no reason to ever short, which we know to be nonsense, right? So how exactly do we determine this? We look at areas that we expect based off of our diagram. So this is our internal structure. We expect this movement up to trade back into where? The prior zone. So we've got two different things here. We've got our higher time frame zone here, or rather intermediate, I suppose. There's your intermediate zone there. Right? We just made a protected high internally and broke below this low. Right? So we expect this trade back in should leave. And in fact it did. Traded back in and then we left. Right? So where's our issue? Our issue is we actually made a valid high internally here and we had a blast, which then validated this as a low. So that's not what we want to see at all. So during this leg up, there's two spots that we can look at for price to fail. And if it fails to fail on both of those, well, guess what? This low that we considered weak is no longer weak. And with study and practice, we look at this and we go, okay, there's a real possibility after that fails there that that this is not getting taken. Because if it was going to get taken, it would have done this. And the reason is because we would expect, if this was a higher time frame movement down, it announced itself, it's now retracing and it's gone. And we didn't get that. So for me, after this occurred in here, you probably see something on a lower time frame to also facilitate that movement up. This is no longer shortable. And I'm expecting not only that high there to get taken, but beyond, right? The second area is this manipulation leg itself. That's a deeper retracement. You'll also notice it went to the midpoint of this zone. What is the chances that there's going to be a wombo combo in there? Shocker. right? Now that couldn't even trade to the 23.6, but that's neither here nor there. We're looking at this movement is now internal structure. We formed a valid high. We then formed a valid low that became protected internally. So our expectation is now that we're aligned, our order flow is bullish, our higher time frame is still bullish, right? And now our intermediate time frame is bullish too. We've got internal structure going on here. So our expectation of this high, until proven otherwise, is to trade back into where? Prior zone. And then if we have failure, which we did pretty catastrophically, we then look to take this high, which it did. We formed a valid low, bang, traded back in, bang, traded back in, gone. Right? So when we're starting, it's actually far better to trade away from the emotion, but we want to trade with trends, especially the new ones that form. Right? So inside of here, you probably had a change in order flow that occurred in a lower time frame. Inside of here, you probably had a change in order flow that occurred in a lower time frame. Failed underneath there. It's also why we like to use 15-minute sweeps. Right? Same sort of things. It's very tricky to be taking these shorts for the retracement back in, although they are valid as well. So you have a short, right? Maybe you're taking that. Maybe you avoid the long here because you're expecting lower, or at least you have a very real possibility of that doing that. And then once that fails and moves there, and you judge that based off of the velocity of this movement, we're determining, is this a higher time frame or not? And we use structure in part of that, but we also use the velocity of the movement, right? So this was higher time frame, obviously, but it was also a news candle, right? And then it blasts up. So now we're looking for lethargic pullback into the prior zone, and we're looking for longs out of here, right? Now, that doesn't mean that there's not valid shorts that come in, but based off of your guys' personality, how aggressive we are, how conservative we are. If you're conservative, you're trading with your intermediate time frame trend, expecting the market to continue doing what it's doing structurally, right? If you're conservative, that's essentially your modus operandi. If you're aggressive, you might have these change in order flow shorts because you're looking at the same thing that we were talking about earlier. You've got non-structural movements that are nearing a potential reversal, which then facilitates this leg down to go long, and you would expect that long movement to be explosive, and so on and so forth, right? Now, with these legs, right, we're now looking at multi-time frame breaks of order flow that occur. For example, when we're looking at that, you want to determine whereabouts the predominant order flow is. Sometimes that's not clear. Sometimes it is. In this case, it's not very clear to me. In other words, I would have wanted to see this low, and you should be able to spot these on your chart almost immediately, right? I wouldn't consider this low, even though that's a bear bar. I think it looks like the market determined that it was. You got to break your order flow, trade back in, gone. This is the basic entry model that we use to facilitate movements up and down, and then we use internal failure along with the Wombo column to get involved. And you'll find that that usually forms around these areas of interest, right? So there's your retracement. Often you won't see it drawn from there. You'll use the last validation candle. I think this might have been the candle that validates, which is why it works out here. But you're looking for the energy of the move. The point of it is that we've got our movement up, right? And now you're looking for internal failure to occur based off of this move now being a higher time frame. We've now broken this high. Cool. We then trade back into the prior zone for the same reason, by the way, that this movement up, we then broke order flow here. We traded back into here, right? This leg. We then traded back in. We expected to leave. Even though this didn't take, obviously there was a good trade that came out of there. We're now doing the exact same thing. We had bearish movement, bearish order flow. We then broke above this high. We actually took both of these. and then we trade back into the prior zone. It's in the retracements. It's in these retracements and the movements that are resulted out of them that profitability lies, right? It's not the 40% win rate or banging our head against the wall and hopefully one of them ends up working. We're just going to go buy every single pullback that comes in, right? You want price to tip its hand, and then we want to get in on the retracement, right? So we've got strong movement, price tips its hand. You're now looking for the retracement to fail where you got your key area of interest, right? We then end up getting failure that occurs in here. Away we go. And then you'll actually notice that there was multiple opportunities in here to get in as well. Now that looks like it was at 9:30, so that's kind of nasty. But retrace back in, gone. Retraces back in, gone. So what you're trying to determine is when the retracement is done in bullish structure or when the pullback's done in bearish structure, and we're looking to get involved in specific areas of interest. That might be avoiding this short, but price tipping its hand for long in bullish structure in your area of interest, in this case the SNDR that broke, like these are your A plus setups that we need to be looking for, right? So mark these out on your charts, right? If you got your SNDR, say here, quite often that gets swept and then the movement occurs, right? Because this narrative should be either trading back in or liquidating the SNDR, and then you get a strong push away, trades back in for the same reason we were talking about with order flow, and then away it goes. Right? Is this a good refresher, or am I going fast, or I think I skipped over some of the very, very basic parts? But does everybody kind of understand what exactly Mikey, Tom, and I look for on a daily basis? I think the multi-time frame aspect of everything is where people get really caught up, because it's, if there's one skill to master for profitability, that's the big thing, right? Is this movement mitigating somewhere, or is this a higher time frame, right? Are we expecting to trade lower, or are we going to get held up here? Yeah, market structure is, it's, once you kind of grasp it, it's, you take a look at the chart and you're like, okay, we're bullish, we're doing this, we should be pulling back to here, whatever. And then multi-time frame is where you start looking at different entries and whatnot, right? So like today, for example, right, we broke below here, but do we mitigate somewhere? Yes, of course, right? Like, you're always going to have a higher time frame movement that gets held up in an area of interest, whether we continue lower or not. It's always going to do that because the market bounces from these areas of interest, right? So this in itself is a model. You've got your 15-minute sweep, and you're targeting the 15-minute high. That's a model. Right? So now what you're looking at is, here's your 15-minute sweep. That's pretty beautiful. What's the follow through like? Strong? Your first trade is your scalp. You've got internal failure here. Your expectation is lower. Oops. And it fails. Right? And lifts off to that high. So there's a whole bunch of different things to glean from this, actually, right? You have your lethargic movement. So you're actually looking at this going, well, this is a beautiful long, and now we've failed internally. Bull says that this internal failure should take that low. That makes sense to me, right? Does that mean we short here for that low? I hope not. I hope not, right? Because if we're here, right? Our 15-minute has still swept and given us our movement. And now what happened? The SNDR, as we talked about, that's now been mitigated. We've now traded back into here. We haven't broken structure, you'll notice. But we certainly did there. And then we took that high. Right? So many of you guys got involved here today. I think that's great. Some of you guys took this up to there. I think that's great as well. I think that multi-time frame analysis and unfair expectations of price are two major things that many people miss. For example, some people will hit this long or a long in here, which is a better example, in bearish structure, right? Where we use valid highs, valid lows, right? We got a body closure above our last structural bear bar, which creates a valid high or valid low. We then have a body closure underneath our last structural bull bar, creating a valid high. Our expectation of this, based off of our diagram, is that it breaks this low, which it did. So if we're going long here and we're here, what's our expectation of that move? So trade back up into the prior zone. But people will go long here and they'll do this. Now that very well may happen. And that's kind of the funny Paul Tudor Jones quote, is that if I'm risking 5 to 1, I could trade like an imbecile and I can still make money. And this is essentially how. If you're trading in right areas of interest and say you have a 5 to 1 here, even if you're wrong and 20% of the time you're right and it actually makes 5 to 1 on that, then that's an excellent trade. And now we look at increasing our win rates. Can you describe what you mean by you speak on manipulation legs and what you look for in a sweep? So ideally, if we are, let's use this prime example, right? So if we look at our 15-minute time frame here, this is what we've got, right? So it's 10:29 in the morning. So our 15-minute sweep and fail, if we fail one end of the of this candle, then essentially we look at this as a weak candle, right? Now usually you want full body candles with this, right? Whereas something like this, that's actually quite nasty, or that closed there and then just unloaded, right? But ideally you want the sweep and fail of these candles. And the reason is because you want there to be almost climactic. You want them to have reason of covering their positions on bearish movements, or vice versa on bullish movements. All trends typically end in climax. So if we're here and we're looking at this movement, ideally we want to see accumulation. And the reason for accumulation is we want institutional sponsorship to go higher, which means they're not just going to, well, not all the time. Sometimes this happens. You might just get this candle failing and then a V bottom blast. Fine. If it's really achieved an objective. But usually when that happens, you'll have major accumulation that occurs here, and you get this, and then you get that sweep, and then it's gone, right? Pertaining to that time frame. So by manipulation, we want them to accumulate a lot of entries in here, and then we want them to run out for CME commissions everybody that's in here that has weak hands. And this is where we start having these banger trades where you seem to catch the low of the day, but you've got a bunch of different things that occur where you're able to do that more consistently. For example, this movement down is very, very different than this movement down here. We've got an SNDR that we can now look to trade back into. Whereas this is a retracement that ends up being a beautiful long, for the same reason that, by the way, we had a 15-minute manipulation here, which then sent us higher. You have the exact same thing happen here on the 1 minute, right? Also, for you aggressive traders, one of the things that pertains to that narrative is the failure to make a valid high or valid low too. Now, accumulating, and now we're looking for them to manipulate, and by manipulation we mean run out orders and fail. Right? So if we're going to, at minimum, in a bearish trend, recall that we can take this short for that low, right? So shorting here for that low, shorting wherever for this low, and we expect to make money. We can also take these longs if we had a setup that then trade back into the prior zone and mitigate it, even if we're wrong about our new trend forming. Is price fractal or something? I don't know. I've heard that on Twitter, but I'll have to ask one of those experts, right? So we're essentially looking, if we're looking long, and you might see longs better than shorts, we're essentially looking for reasons to get involved in here that increase our probability, because we don't want to buy on any old bearish candle and then get clapped, right? We're essentially looking for the market turning around, and we use the curve essentially for that. And what I mean by the curve is that you've kind of got your very lower time frame doing something like this, and then you'll get your micro change in order flow. We're looking for reasons to expect that the market is shifting order flow to go from bearish to bullish or vice versa. Sometimes that's a little bit easier to see, and usually on the bearish side that's easy to see. Oftentimes it's not, right? For example, in here, just all of a sudden price is here, great. Whereas that didn't really work out very well for us in there, did it? So we can't just buy after bullish bars, right? Usually we want a sweep and failure. As part of a model, I think it's valid to use liquidity as an entry or something necessary for entry. So the manipulation takes everybody out. And we know that it's manipulation because they ran out stops and then reversed the trend, right? So hypothetically, say we got long somewhere, and here you're then putting your stop underneath that because you're expecting this movement to be a low of some form. You're not necessarily looking at this low as the low of day. That could evolve into that, but that's not what we're looking for, right? So now we're pairing and stacking confluences together based off of market structure that at minimum, this movement happening at this time, which is also important, should at least trade back into this SNDR. At least. And even if we're wrong, we're going to make money trading something like this, which then continues on. But given that the 15-minute has now swept and the 5-minute has now swept, we're not looking at this as a lower time frame reversal. Right? This is now our third push down. The market usually happens in threes, twos and threes, depending on its objective. And now we're expecting that if this wants to go and we mitigate this area, that we could be looking at a 15-minute move, which would then be trading up to this high. Right? So now we're looking at how price is delivering, and we're looking at the market attempting to resume that bearish trend and failing. Our stop could still be below here. We got our attempt to move it back down. Right? So now maybe we're break even. As we've gotten price pushing away, our stop can now be underneath here. We don't want to invalidate that area. And so on and so forth as this price just continues onwards. Right? Now you'll notice as well, internal failure, that's when things start getting a little dicey. Right? Because now order flow has shifted. The market is telling us, at least right now, we don't want to go higher than this. And the only reason we wouldn't want to go higher than this is because either some institution here has a lot more they want to get filled at, in this case, or that we're trading up to this structural area because an institution has a lot of shorts, so they want to pile in here, and this movement is going to continue down to wherever it wants to go. The only two options. And then we wait for price to dictate its hand, right? And we look for failure as well. That's a little bit more of an advanced sort of concept and structure, but just to confuse you a little bit more, right? But the key is that we're certainly looking at from a macro standpoint, we look at what the intermediate time frame is doing. So if the 15 minutes bearish, we're determining using structure just how many attempts to reverse this trend there are from an intermediate time frame perspective. And if there's a lot, now we're starting to look at signs down here for this reversal. So using sweeps that go in there, we're using intermediate attempts to resume the trend. We would expect this. We got that instead, right? Now that goes in direct conflict with our structural narrative of continuing this bearish trend. And away we go, right? So we often make things a lot more confusing than it needs to be, but essentially, waiting for that 15-minute sweep in the late stages of a trend, usually we can find ways of getting involved that that have pretty low risk that can give us quite a bit of profit. Any questions, lads? A little bit of a brief overview that turned into a little bit more of an advanced sort of thing. But I know there's been a bunch of questions in chat the last bit. You guys want me to go over anything specific? Yes. Yeah, the last thing I'll say, which isn't really structure related, is that a lot of the psychological stuff that you guys are doing is, I think cutting edge is an understatement. This is stuff that hasn't really entered the trading space. And I can say that with confidence, as we do know some, like we've spoken with people from very prominent hedge funds that have psychologists on their payroll that don't go into this sort of stuff. This is like major game-changing things. And the NLP side of it and the psychology side of it manifests itself differently depending on how much you put into it. What I mean by that is your belief that it works and the faith that comes in with the desired outcome that you have. And what I mean by that is that quite often it won't be some explosive thing the next day. It might be in some cases, depending on how sound you are with your strategy. But in other times, what ends up happening is you're actually being shown very specific things in your day and in your trading. That could be a particular mistake you're making. It could be in the form of, and I've experienced this firsthand myself, where it's almost like it's not even you hitting the button. That's an entry or an exit. I don't know if you guys have ever felt that. Anybody ever felt that, where you were just kind of watching something and then you like hit buy or sell and the trade ended up working out quite nicely? Or just me? Yeah. That's essentially programs that are running in the background that we're activating. And there's a whole bunch of different stuff that gets activated when we start neurochemically adjusting our belief systems and removing barriers. Lots of different stuff happens. It can be a little taxing on the mind, so make sure you guys are getting hydration and some rest, but it's really, really interesting. So my implore on you guys is that there's likely one thing every day that will continue, and I've mentioned this a million times, it will continue to repeat itself over and over and over and over again. One particular thing. That could be a strategy, that could be a methodology, that could be a line of thinking. And if you just take some time and do some introspection and see what seems to be happening over and over again, it's actually like almost like a future you that's saying, get rid of this or continue doing this. You're seeing it. Why are we not making our entire system around that? Right? And that's essentially what a lot of that psychology is coming out on. Now, we're going to get you guys into a much more energetic and fired up state where you're going to want to run through a wall on Thursday. And it's going to smash limitations and barriers and whatnot too. So you're not really going to have the same sort of effect that the timeline did. This is going to be something a little bit more intricate. And yeah, I'm just excited to see where you guys come out with that. But anyway, yeah, I think we'll wrap up this stuff here. If you guys have questions about any particular thing and whatnot, let's either do them now or ask, and we'll put some charts in general and whatnot too. Yes. Yes, it's been recorded. I'll upload this right now as well, and we'll put it in the YouTube videos channel. Cool. Appreciate all of you guys, and go catch that toddler. God knows what they're into. We'll see you guys tomorrow morning for some more fun. Bye 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 bye.